We still think silver is in a rampage. This is what you would call the midpoint stumble. What we expect this month to see is silver firm again in February. Probably not see a new high this month. And was the January high stand. True for gold and silver. We see a firming action such that by the end of the month, we're well back up off this low and somewhat approaching the January high. It's in March that I would expect that if after we see that stability action this month, that you then resume. And March says, okay, game on again. And then again, if we're correct in our analysis, and we have multiple reasons for coming up with this observation of the 6-month surge, it's not just that one thing. You could see silver reach into the several $100s, like $300 to $500.
Silver looks far from finished, and analysts like Michael Oliver think the current pullback is just a pause, not a reversal. What we're seeing now resembles a classic midpoint stumble, a temporary dip inside a much larger bullish rampage. February is expected to show firmer price action, likely stabilizing without breaking January's highs in either gold or silver. By month's end, prices could recover meaningfully from recent lows and lean back toward those January peaks. The real ignition, however, may arrive in March. If this consolidation holds, Oliver's 6-month surge thesis suggests silver could re-enter game-on mode, opening the door to dramatic upside projections even into the $300 to $500 range. Now, we present the clips from Michael Oliver's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
We look at the trend of silver and gold in long-term momentum metrics. Like, for example, we measure the monthly price action of silver gold in relation to, let's say, a 3-year average or a 3-quarter average. These are fairly long-term yardsticks. And we don't just overlay the average. That's not meaningful. Sometimes you can cross those averages and who cares? It's when you plot the bars of price in their relationship to a given moving average. Like, is it above it or below it? Okay, and if so, what's the high of the month, low of the month, close of the month in relation to that given moving average? And those averages change according to month, 36 month, every quarter on a 3-quarter average. But anyway, you get a different chart when you plot momentum in bar chart form against certain long-term average. And you see trend structures, the kind of things that an average price chart guy would, like, he'd draw a line across a couple highs and say, oh, we broke out over that line. Or a floor that you've used 2-3 times and you break below it, therefore it's all over, it's going down, that kind of. We do it with momentum. Almost always when there's a trend shift, even short-term, intermediate or long-term, momentum usually will break its structure and indicate the new direction prior to price smacking you in the face and saying, oops, I'm going down or I'm going up. Okay. So it's a good leading indicator, and you can anticipate trend changes, especially when you see on momentum a structure that just is so clear and used so many times as resistance or as support. And usually they don't last forever. I mean, you can only use a certain level so many times, and finally, if you hit it too many times, you go through. Okay. That's true with momentum. Anyway, at that point in time, silver on our long-term momentum metrics was already fully positive. In fact, one of our primary entry points was before that, was back in, if you recall, silver was capped in a range with a high above 35 in late 24 and a high above 35 again in March 25. Confined for, there was like a year there where it twisted and turned at that level and to the downside, a congestion zone, but very wide. The third time that it came back up toward that 34, 35 level was back in June last year. Silver still in the mid-30s, still in that range, but momentum said, you're breaking out. Price had not yet broken out. That would have required getting up to 35.50, blow out those 2 prior highs on the price. But as it approached 35, that third time, our momentum broke out and we said, okay, acceleration phase for silver now commencing, meaning rather than this 2 steps forward, 1 step back process, it's going to be like 5 steps forward, 1 step back. Okay. And boom, later in the year, we're at the $50 level plus. So challenging the old idiot highs. But then something else happened. And that was in November, a month after our conference in Toronto. At that point in time, nothing had changed on the silver price or long-term momentum positives. They were positive already. No big deal. But why is it all of a sudden after the November close, which I think was in the 70s or something, silver broke out versus gold, where when you plot the spread chart relationship between an ounce of silver into an ounce of gold, you go back 50 years, you can do that. You'll find that back in the 1980 bull surge in silver was 6.5%. Divide an ounce of silver, an ounce of gold, of the price of gold. Okay, keep that in mind. And then it dropped back down. And then in that same 50-year price range, in the second surge in that range, which peaked in 2011, $50, silver versus gold reached up to 3.1%. Early last year, silver was at 1% of the price of gold. I mean, you think it's going to free? Okay. Anyway, so during the year last year, as we turned up, but especially after that at that November close, when we plotted that chart, you blew through a ceiling on that spread chart, where if you plot each month's close, there was a clear multi-point ceiling that kept stopping all the rallies in silver versus gold. We closed above it in November. And it was at that point we said, okay, the lid is really coming off now, because silver, whenever it does this versus gold, which it did in 79 prior to the explosion in 1980, and it did in late 2010 prior to its explosion again to 50, that spread broke out. And when that broke out, it told you the temper and tone is changing. So what happened since then? Well, we went up to $120. In 2 months, we went up to 120. Normally, when you see these spread breakouts of silver versus gold, like in that 79 period, in the summer of 79, or September 2010, it's over the next couple quarters that you see the consequence, not over 2 months. It's a massive chart breakout spanning a year or more of resistance, where silver just couldn't get up above this level. When you gush through that, you gush, and you usually gush for a couple quarters. And yes, in the middle of each of those surges, there is a shin kick that, oh gosh, it's all over. This one came a little sooner than we expected. We were frankly expecting a midpoint stumble late this month or early March. Instead of being like in the third month of the 6 month or so surge, it occurred at the end of the second month, earlier than we expected. So we were wrong in that regard. And it was deeper than we expected. But frankly, when we look at the depth of that sell-off, it's got down to 71, 72, on Monday, first day of this month. So we had like a day and a half collapse, really. It was all a day and a half, the whole drop, day and a half. We dropped back to the rising 3-month average on silver, a level it has not seen since the first half of last year. So to return to a rising average that is now acted like support. Sometimes you have to return to the mean, 3-month average isn't super long term, but it returned there, and it tested it again today. So anyway, we view the pullback as being a very sharp but non-event in terms of changing our outlook. We still think silver is in a rampage. This is what you would call the midpoint stumble. And what we expect this month to see is silver firm again in February. Probably not see a new high this month. In which the January high stands. Okay, true for gold and silver. But we see a firming action such that by the end of the month, we're well back up off this low and somewhat approaching the January high. It's in March that I would expect that if after we see that stability action this month, that you then resume. And March says, okay, game on again. And then again, if we're correct in our analysis, and we have multiple reasons for coming up with this observation of the 6-month surge, it's not just that one thing. You could see silver reach into the several $100 zone, like 300 to 500.
Silver's long-term outlook remains aggressively bullish when viewed through advanced momentum analysis rather than simple price charts. According to momentum-based methodologies used by analysts like Michael Oliver, silver and gold trends are best understood by measuring monthly price behavior relative to long-term moving averages, such as 3-year or 3-quarter benchmarks. These momentum structures often break before price does, acting as powerful leading indicators. In silver's case, momentum confirmed a breakout well before price cleared long-standing resistance near $35, signaling an acceleration phase. A recent sharp pullback is viewed as a classic midpoint stumble, not a trend failure. If historical silver-to-gold ratio breakouts repeat, silver could resume its surge and potentially reach the $300, $500 range over the coming months. Let's get back to the interview.
We got to watch T-bonds going forward too, but there's external factors. You don't just look at a silver and gold chart. That's a mistake. You got to look at these major external factors, because what they're saying often will alter something you might be thinking about silver, like getting negative because of the recent drop. Now you got to look at certain other things. But as for Bitcoin, okay, it peaked at 128,000 a couple months ago, back in October, November. As it was making that high, and everybody was talking $1 million Bitcoin, whatever. Momentum of Bitcoin, long-term momentum of Bitcoin did not look at all like what the Bitcoin price chart. Instead, the momentum chart looked like a lamer and lamer advances, with each price advance getting to new highs. The momentum readings kept making lower highs, which they were getting more anemic. And they built a floor since 2023. They'd used it 3 times at the 3-quarter moving average. They don't always build a structure at an average, but in this case they did. The 3-quarter moving average of Bitcoin, you didn't close below it 3 times. You traded down to it 3 separate pullbacks during that price advance. We could tell you were going to break it this time. Sure enough, we broke it. Couple months ago, our trigger levels were 107, 104. You can get a market like silver's been overbought. Back in the 79 to 80 move, for example, you would have missed the entire move had you looked at RSI, monthly RSI. It got overbought and stayed there for a year. Above 80 on RSI. You would have missed the entire bull move if you'd gotten out first time it got overbought. Okay, structure. Again, we plot bars, monthly high, low, close. But in relationship to what percent above, what percent below, or how many points above, how many points below a given moving average. And when you plot it as an oscillator in relation to that mean, might be a 3-year average, 3-quarter average, a 3-month average. You plot it versus these various means, and you'll get a chart that looks different from the price chart. Same high-low monthly bars, but instead of just based on where it is in relation to the US dollar, which itself is not a fixed yardstick anyway. It's a piece of rubber. Okay. But when you plot it versus its own moving averages, long term down to intermediate term, even short term, you'll get an oscillator that it's a bar chart oscillator, but it doesn't always reflect what the price chart. The price may say, look, I just made a new high. And you look at momentum and it says, I'm making a new high.
Market analysis can't stop at silver and gold alone. External drivers like treasury bonds and Bitcoin matter just as much. Momentum-based analysis, a hallmark of Michael Oliver's methodology, often reveals trend shifts long before price charts do. Bitcoin is a clear example. Despite peaking near 128,000 amid extreme optimism, its long-term momentum was weakening, forming lower highs and signaling exhaustion well before price broke down. By contrast, silver's recent pullback looks technical, not structural. Using momentum plotted against long and intermediate term moving averages rather than RSI or raw price helps identify true trend strength. This approach filters noise, avoids false overbought signals, and keeps investors aligned with major market moves. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.